Ladies and gentlemen, we've got some exciting news on the horizon. Earnings are coming out next Friday, and there's already some major buzz around NIO. One of the most surprising revelations, a part of NIO's business has officially turned profitable. Yes, you heard that right, profitable. But before we get too carried away, let's clarify exactly which segment has reached this milestone. It turns out that NIO's after-sales service division has managed to achieve profitability. This includes everything from maintenance at service centers to accessory sales, such as window covers and other car add-ons. The company has reported that throughout 2024, this part of their business has consistently remained in the green. Now, that's a big deal because it shows a shift in strategy, moving towards sustained revenue generation rather than just relying on vehicle sales alone. Some key statistics provide even more insight. Previously, only about half of new NIO and Onvo vehicle buyers opted to purchase accessories. However, by Q4 of 2024, that number surged to 90%. That means nearly every single person taking delivery of a NIO vehicle is also buying some form of an add-on, whether it's protective gear, aesthetic upgrades, or convenience-enhancing features. That's a significant increase and a major contributor to the profitability of this segment. Another noteworthy point is the improvement in margins within after-sales services. While NIO didn't disclose the exact numbers, they did confirm that margins in this area have expanded fivefold compared to previous years. That's a staggering increase and highlights the effectiveness of their revised approach. Part of the reason behind this profitability shift is that NIO has significantly cut back on freebies. Previously, they were extremely generous with complimentary services covering scratches, interior damages, and minor fixes at no additional cost to customers. While this certainly bolstered their reputation for excellent service, it wasn't sustainable in the long run. As a result, the company made strategic changes, ensuring that while service quality remains high, customers now bear a fair share of costs where appropriate. Looking ahead to 2025, NIO intends to maintain this strategy, keeping its after-sales division profitable as a key component of its overall business model. Now, let's dive into what we can expect from the upcoming earnings report. Things are about to get really interesting. In Q4, NIO achieved record-breaking delivery numbers, reaching 2,689 vehicles. Given this massive increase, it's almost guaranteed that the company will report record revenues as well. But the question is just how much revenue are we talking about? To put things into perspective, let's look at Q3 numbers. In that quarter, NIO delivered 61,855 vehicles, generating $2.379 billion in revenue from vehicle sales alone. So, if we apply a similar calculation based on revenue per vehicle and scaling up for Q4's delivery numbers, we arrive at an estimated $2.79 billion in vehicle sales revenue. However, there's an important caveat to consider. A significant portion of Q4's increased deliveries came from Onvo models, which have a lower average selling price than other NIO vehicles. This means that our revenue estimate might be slightly inflated. In reality, the actual vehicle sales revenue may land slightly below that $2.79 billion projection. Now, let's add in NIO's other revenue streams. In Q3, their total revenue reached $2.681 billion, meaning around $400 million came from non-vehicle related sources such as charging services, merchandise, and other business ventures. If we apply a similar estimate for Q4, we're potentially looking at a total revenue figure surpassing the $3 billion mark. That's an impressive milestone for the company and would certainly send a strong message to investors. But here's the critical part: profitability. Revenue is great, but what about losses? At the end of the day, that's what really matters. Can NIO finally close the gap and edge closer to breaking even? Despite the positive developments in the after-sales segment, it's important to note that NIO is still not expected to turn an overall profit in Q4. Their ultimate goal is to reach profitability by Q4 of 2025, but for now, losses remain an issue. For context, NIO has consistently reported net losses ranging between $600 million to $700 million per quarter. And unfortunately, there haven't been any strong indications that these losses are significantly shrinking just yet. Research and development R&D costs remain steady, showing no signs of reduction. Additionally, capital expenditures CapEx saw a boost in Q4 due to Onbo's marketing push and other promotional incentives aimed at driving sales. So, in all likelihood, spending increased rather than decreased. This leads us to the big question: how much of a loss will NIO report? If losses come in under $500 million, that would be a huge positive signal. It would indicate a strong trajectory towards profitability, showing that cost-cutting efforts and improved revenue streams are making a tangible impact. On the other hand, if losses remain around the $600 million to $700 million range or worse, increase to $800 million, it could create concern among investors, potentially triggering volatility in the stock price. Another crucial factor to consider is margins. In Q3, NIO reported vehicle margins of 13.1%. This is another area where we could see some positive momentum. The Onvo lineup was designed with cost efficiency in mind, which suggests that its margins could be better than those of earlier NIO models. If that's the case, we might see a boost in overall vehicle margins, potentially rising to around 14% or even 15%. While this would be an improvement, it still wouldn't be enough to push the company into profitability just yet. Ultimately, what should we take away from all this? Here's the summary. Record-breaking deliveries in Q4 mean we should expect record revenues, potentially exceeding $3 billion. The after-sales service business is now profitable and growing, thanks to higher accessory sales and better margins. Profitability for the entire company is still out of reach for now, but narrowing losses would be a bullish sign. If net losses fall below $500 million, that's a very promising indicator. If losses remain around $700 million or worse, it could signal trouble and spook investors. Margins are expected to improve slightly, but not enough to flip the business into the green just yet. So, what's the bottom line? The Q4 earnings report will be a pivotal moment for NIO. If the numbers align with optimistic expectations, record revenue, narrowing losses, and improving margins, it could set the stage for a strong 2025. However, if losses remain stubbornly high or worsen, it could raise concerns about the company's financial health. We'll have to wait and see how things play out when the numbers drop next week. But one thing is for sure: this earnings report will be one to watch closely. Let me know your thoughts in the comments. What are your expectations for NIO's Q4 earnings? Will we see a big surprise, or will the numbers fall in line with projections? Drop your predictions below, and let's discuss. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.